Hi there, welcome to Kneppy Invest. We are in the middle of reporting season in February, and almost every single day I am looking out for particular financial reports from companies I either own or hope to own. Yesterday I did a video on A2 Milk, share price down, I think it was like 8% on the day. Share price of that company is down a further 6%, so the market hasn't liked that particular financial report. But another company I was really looking forward to see how they performed in the past half year was Johns Lyng Group. I haven't done many videos on this company, if any at all, yet it is a fairly large proportion of my portfolio because I'm very bullish about the long-term potential of this company. And we have seen this share price under pressure over the past month and a half because the CEO decided to sell out some of his shares, and market for some reason absolutely hates when the CEO decides to sell out his shares because they believe, for some reason again, that means the CEO is only selling out because the business is not performing well enough. So I was really looking forward to see how this company has performed in the past half year. Was the market right or was the market wrong? Now, I am bullish about the long-term future around Johns Lyng Group simply because of what they do. So this company and their core business, they have a few say business divisions, but their core business is rebuilding and restoring buildings and contents that are damaged by insurance events like weather, a few other things like fire and that stuff like that. But the big one there for me anyway is weather. And we are going to see an increasing amount of natural weather disasters. Auckland itself has seen two in the past month, significant weather events that Johns Lyng Group will benefit from. So this company has a diversified client base that includes major insurance companies, insurance brokers, loss adjusters, local and state governments, and body corporates and owner corporations. So I was very interested to see how they perform in this particular quarter or this particular half. And then I saw the results and it blew me away. One of the best results you will see. And not only were the results pretty good, they also upgraded their financial year 23 guidance. And that's another thing I always want to see when a company releases financial results is an upgrade to their guidance. So because the results were good and because they gave an upgrade to their guidance, we saw the share price absolutely take off. Last time I looked, and I'm recording this video about an hour before trading has finished for the day, the share price was up about 15%. Now, Johns Lyng Group their story starts many, many years ago, but the story for this video starts on the 20th of December 2022. Share price for this company dropped 12%. From $6.81 to $5.97. So keep that share price, $6.81, in mind. And the whole reason the share price dropped was because the CEO, Lindsay Barber, decided to sell 4 million of his shares. He still retains 8.8 million, and the market absolutely hates this sort of thing because they believe that if the CEO is selling out of his shares or some of his shares, something is wrong with the business and they just have to sell. That's why the share price dropped 12% on this day, and there was no significant bad news from the company. In fact, the company reconfirmed its earning guidance for financial year 23. So whenever I see this sort of price drop in a share price of a company I like, because of irrationality from the market, and this is the market being irrational, when they sell down a company by 12%, just because the CEO decides that he needs to diversify his personal asset portfolio, that's an opportunity to take a position in a company that you might think is high value. And I definitely think Johns Lyng Group is a very high quality company that is on the ASX. Now let's have a look at the half-year results. And one of the reasons, probably not the biggest reason why the share price did pop up today by about 15% is because of the half-year results. But it's mostly because they did upgrade their guidance. But these are stellar numbers no matter how you look at it. So sales revenue up 71.2%. Group EBITDA up 63%, net profit after tax up 83.6%, and earnings per share up 87.8%. We'll talk about valuation later in the video. One of the One of the talking or selling arguments against Johns Lyng Group is that was the valuation. So I did hear quite a few people talk about the P/E ratio of this company being way too high, being like 80 or 90. But with this significant results of the company, earnings per share of 9.68, I'm going to say, or even argue right now, at the current share price and current valuation, this company is actually undervalued, not overvalued, just because of the significant growth this company is experiencing right now and the potential for significant growth in the future. And more importantly, as I've already mentioned, the company also had a guidance upgrade in regards to sales revenue and EBITDA. So they've increased their revenue projections by 11.2%, and they've increased their EBITDA projections by 5.5%. Now, I'll be honest with you, the only thing this company does is earnings upgrade. This company has provided the market with a multiple earnings upgrade over the past few years. They have never done a downgrade that I can remember. And that's why the performance of this company in terms of the chart has been absolutely amazing ever since this company listed on the ASX was about 5, 6, maybe even 7 years ago. So an earnings upgrade is the sort of thing you always want to see when a company releases their half-year results. As I've mentioned previously in this video, one of the selling points about Johns Lyng Group is a possibility or the argument that it is overvalued. So people just see a P ratio of 80 or 90 and think automatically the company is overvalued. But if a company can double their profits every single year, a P ratio of 80 or 90 is actually low for that particular company. And because Johns Lyng Group is, increasing their profit by a significant amount every single year, I would have argued that a P ratio of 80 to 90 was actually on the low side. And now we can calculate the P ratio of this company based off the earnings per share in the first half of financial year 23 and the second half of financial year 22. So earnings per share went from 5.2 cents in the second half of last financial year up to 9.68 cents. So if we look at the trailing 12 months earnings per share, it's at 14.8 cents, which means a P ratio at a share price of $6.50 is only 43.9. But if this company continues to grow, or just for argument's sake, they don't grow at all in the second half, that means their earnings per share for financial year 23 would be roughly 20, which means a P ratio of this company at $6.50 is only just above 30. But if this company continues to grow at current rates, the P ratio, the forward P ratio of this company at a share price of $6.50 is probably more like 20 to 25, which means this company is not overvalued at current prices. So I do see some value with Johns Lyng Group right now. And if we do take a look at the chart, the daily chart for this company going back to March last year, so almost a 1-year chart for the company, we have seen a lot of volatility in the share price. And we can see the share price going up and down in waves. And when the share price gets down to around about $5 to $5.20, or even $5.30, that's probably a good time to buy, particularly because at that point in time, I think the market starts to realize there might be some value in this company. And recently, the share price did get down to $5.40. We saw that 12% dip in the share price back in December on pretty good volume. So the market didn't like that. And I do think, and this is just my opinion, the only time to really take notice when some directors or management of a company sell out the shares is when a group of them sell out at the same time. I've seen that happen a few times, and that does possibly spell bad news for the company. But when the CEO sells out some of his shares, he might or she might sell out for many reasons, like to buy a yacht. And a brilliant example of this was Blackmore's. Maurice Blackmore, if I get his name right, sold out of some of his shares back about 7, 8 years ago of Blackmore's, the share price was 20, to buy a yacht. The share price then went from $20 to $200 in a very short period of time. You don't think he wants to not sell these shares to buy a yacht at $20 to maintain his holdings until they get to 200? So CEOs and management don't know the forward movement of the share price. And sometimes they just sell out for different reasons, not necessarily because they think the share price of a company or the company itself is performing badly. And it seems like the market got this wrong. They thought the CEO was selling out not selling out, but selling some of his shares because the company is obviously doing badly. So market got this absolutely wrong. But I think, and this is just my opinion, the share price has way more to run from here. The high, or the share price high, all-time high for Johns Lyng Group is just under $10. And I think based off their half-year results and potential for further growth in the next few years, particularly if we have more significant weather disasters throughout the world, there is significant growth for this company moving forward from these current prices. And that's all I have for this look at half-year results for Johns Lyng Group. Pretty good results. As a shareholder, I might be a little bit biased, but these are the sort of results I was looking for. And the very fact they did upgrade their guidance for financial year 23 was icing on the cake. Although I probably would argue the main reason the share price has popped up 15% was because of that upgrade. So hopefully this little bit of negative sentiment, because the CEO did sell out, has now been shifted to positive sentiment. Anyway, so if you have any questions about Johns Lyng Group, maybe you're on the flip side, you don't like this company at all. I'd love to hear different opinions than my own so I can listen to those different opinions and potentially change my mind on this company or any other thoughts you might have. I'd love to hear them, so leave it in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.